The stock market has not been good this year so far. All major indexes have provided a negative return, and if we look at individual stocks, it's even worse. But this is exactly the time to buy stocks and ETFs at a cheap price. Most of this downward movement is due to fears associated with tariff wars and inflation and their long term impact. This might end up being a recurring theme throughout this year, which, in my opinion, is also great news for long term investors. On this channel, I mainly discuss income oriented ETFs and dividend paying stocks. Such investments do not get the same kind of attention as growth oriented stocks. But during a downward market, such stocks and ETFs, in my opinion, are much better investments than growth stocks because they often end up being heavily undervalued, while at the same time, their dividend yield goes up as the stock price goes down. So it is an excellent time to lock in higher income yield for quality investments. Without further delay, let's get started. The first ETF that I'm definitely taking a look at is HYLD. Year to date, this ETF is down over 7%, but over the past 1 year, it has steadily increased its income payouts. Based on its current stock price, it is yielding over 13% annually. This ETF uses a 25% leverage and it is a very concentrated version of the S&P 500 index. It has a similar sector mix to the S&P 500, but it only holds 90 companies instead of the 500 in the S&P index. If you look at the SPY ETF's return so far this year, it is down approximately 5%. So the added 2.5% downturn in HYLD is mainly due to its 25% leverage. In my opinion, this is an excellent opportunity to buy this ETF and lock in a yield of 13% or higher, depending on how it performs in the upcoming weeks. But if you find HYLD too concentrated, you might want to take a look at USCL. Similar to HYLD, this ETF uses a 25% leverage and is based on the S&P 500 index. However, unlike HYLD, it tracks the complete index. Thus, comparatively, it is less risky. This ETF also recently increased its income payout by 10%, and based on its current stock price, it is yielding around 12% annually. When compared to HYLD, you're trading off slight reduction in annual yield for a less concentrated portfolio. Depending on what you're looking for, either of these two ETFs could end up being a good choice. Now that we have looked at S&P 500 index based ETFs, let us take a look at ETFs based on the Nasdaq index. The first among these is HHIS, which is the ticker symbol for Harvest Diversified High Income Shares ETF. HHIS is a recently launched ETF, and so far this year it is down over 15%. This ETF is a combination of a suite of single stock based covered call ETFs, all recently released by Harvest. As you can see on the screen, all these companies are high growth tech stocks. In fact, if we put the top 10 holdings of Nasdaq next to it, there is quite an overlap. Just like HYLD was a concentrated version of the S&P 500 index, this ETF is a heavily concentrated version of just the top tech companies in the Nasdaq index. Also, the holdings within this ETF use a 25% leverage similar to HYLD. Year to date, Nasdaq index is down over 8%. So it makes sense that a highly concentrated version of Nasdaq, which also uses leverage, is down over 15%. And that is the precise reason why I think this is a great time to start investing in this ETF. Based on its current stock price, it is yielding 28%. So definitely the yield is very attractive. One thing that goes against this ETF is the fact that it is quite new on the market. But the way this ETF is structured is very similar to HYLD. Based on how HYLD has performed over the years in relation to the S&P 500 index, I think we can expect a similar trajectory from this ETF in relation to the Nasdaq index. So this seems to be a great time to lock in not just high yield but also potential long-term capital gains. At the same time, if you find the concentration in only a handful of stocks too risky, there are alternatives you might like better than HHIS. The first of these is QQQY from Evolve, not to be confused with QQQY from Defiance, which trades on the US market. whereas the one from Evolve trades on the Canadian market. This is also a concentrated version of the Nasdaq index, which only focuses on technology stocks. However, unlike HHIS, QQQY holds a total of 45 companies. Additionally, there is no leverage used, so the risk is better spread out across more holdings. However, for this added security, you're trading off the high annual yield offered by HHIS. QQQY has a lower annual yield at a little over 17% based on its current stock price. Nonetheless, in absolute terms, it is a great yield when you look at all the covered call ETFs in the market right now. Given the fact that year to date this ETF has declined by almost 14%, the current yield of 17% may not last long if the markets experience an upturn in the coming weeks. The next alternative to HHIS is QQCL, which is the Nasdaq 100 covered call ETF offered by GlobalX. This ETF actually holds all the stocks within the Nasdaq 100 index and also uses a 25% leverage. Again, the risk is better spread out across more holdings, but this means that the yield goes even lower at 13% annually. Year to date, this ETF has experienced a downturn of a little over 11%. So, just like the other two ETFs, this ETF represents an excellent opportunity to lock in potential long term capital gains and high income yield. There is also an unleveraged version of this ETF with the ticker symbol QQCC for those of you who don't want the leverage. Depending on how much risk one is comfortable with, any of these ETFs could end up being an excellent choice. Last but not the least, I want to highlight a dividend paying Canadian stock which I already hold and which I believe is trading at a discount right now. This stock is CIBC, or the Canadian Imperial Bank of Commerce. This stock is one of Canada's six major banks, also referred to as the Big Six. The banking sector in Canada is quite robust and well regulated. In fact, if you look at the holdings of TSX 60, you will notice that these banks feature quite prominently in its top 10 holdings and are an integral part of the overall Canadian economy. There are also numerous ETFs which solely focus on just these six banks. But instead of buying an ETF which holds all six of them, I prefer to buy the one which I believe is the most undervalued among them, and that is CIBC. Here we have a table which shows us their year to date return, their dividend yield based on their current stock price, and their price to earning ratios. For starters, CIBC has the lowest price to earning ratio among all the banks. At the same time, it is paying a higher yield than RBC and National Bank. The only bank paying a significantly higher dividend is Bank of Nova Scotia, but it also has a higher price to earning ratio. If we look at the year to date return, CIBC has actually lost over 11% and is among the worst performing banks in the Big Six, along with the Bank of Nova Scotia and the National Bank. And this is where I think CIBC is highly undervalued. If we look at the most recent quarterly reports of these three banks that are down over 11%, we see that CIBC performed quite well. Year over year, their revenue, net income, and net profit margin had all gone up. Bank of Nova Scotia, in comparison, performed terribly, so it makes sense that its stock is down. Also, National Bank had a reduction in its net profit margin, so it makes sense for its price to be down as well. But with CIBC, it makes you wonder why the stock is down since last quarter, despite performing well in every metric. The primary reason for this, as far as I can tell, is fears around growing inflation and cost of borrowing. Since CIBC is primarily a retail bank, it is quite sensitive to changes in borrowing trends. If borrowing costs go up, less people are likely to borrow, which means a possibility of reduced revenue in the future. Hence, we see a downward trend since investors are already pricing in the expectation of reduced revenue and net income in the upcoming quarterly report. This is a classic case of a downward trend caused by short term concerns. It is indeed possible that in the upcoming report the revenue and net income might go down, but that does not necessarily mean that the company cannot recover over the next few quarters. Also, if we look at how the company is actually performing, it tells a different story. Over the past year, CIBC has actually increased their customer base in the personal and business banking segment and also seen increase in loan volumes and margins on those loans. Not to mention that they recently increased their dividend payout, something the management will not do if they are expecting a reduction in revenue in the near future. I had last purchased shares of CIBC back in November 2023 when it was trading in the $50 range. Since then, its return have been quite excellent, both in terms of capital gains and dividend paid out. It has been a great holding to have in my portfolio. The recent downturn in the stock's price is mainly due to external factors which are beyond the company's control. When we combine this with the fact that the company is actually performing quite well based on its most recent financial reports, as well as its low price to earnings ratio, I think this is the right time for me to add more shares of this stock in my portfolio. With that, we come to the end of this video. Let me know in the comments section what other stocks you're planning to add to your portfolio during the current bearish market. As always, the information shared in this video is based on my research, includes my opinion, and does not constitute as investment advice. Make sure to do your own due diligence before making any investment decisions. If you found some value in this video, don't forget to like, share, and subscribe. I will see you guys in the next one.